Hi everybody, this is Dave Tubbs from the Greater Kitchen-Waterloo Chamber of Commerce. Welcome to our first webinar, this one on bulletproofing your business with Paul Drouillard from DSK LLP. So with that, I'd like to pass over to Paul.
Hello everybody, thank you very much. I understand today that they're using me as a guinea pig for the first webinar, so hopefully I don't fail too miserably and we do actually learn something today. Bulletproofing business, we can actually switch to the next slide here. Get a technical difficulty. What I just want to cover today, just a little bit more, is just types of organizations, how you actually register yourself, and how you actually carry on your business. What I do encourage you to do is ask any questions at any time. I'm used to giving seminars where I can see facial expressions and field questions as they come up. So please do feel free to chat out anytime. So the first structure I want to go through is when you think about starting up a business, what you normally think about is how do I start? And the most common way to start is by becoming a sole proprietor. And what that means is that you are the owner, you are the sole decision maker. The profit that you make is your income for the year. And profit, for those who might not understand, is strictly just the revenue that you make minus the expense that you incur. There are issues that you have to be concerned about. One is the unlimited liability. And what that means is that when you're the sole proprietor, you are responsible for all the debts that the company or your business incurs personally. For example, if you have any bank debt or any vendor debt, they can actually go after whatever you own personally, your house, your car, your savings account. So that's a real issue that you have to be concerned with, is the limited liability factions there. Some of the areas too that you might have to be concerned about is restrictive financing. When you're a sole proprietor, banks look at you a little differently than a corporation. They might provide you debt, but you'll have to put up your house as collateral, you'll have to sign over your firstborn, etc. So just be aware of that. Tax advantages. Now, the one nice advantage of being a sole proprietor when you start is that unfortunately most businesses fail to make profit the first year. They tend to actually have a loss in the first year. If you have a loss in your sole proprietor, because you're a sole proprietor, you actually record your income on your personal tax return. So albeit your loss goes on your personal tax return as well. If you have any other income, i.e. if you have a rental property, you have income from that. If you have investment income, if you might have been an employee for half the year and decide to start your own business the other half, the loss can be used to offset the profit from the other sources of income, which could therefore actually reduce or eliminate your tax liability for that year. So there are some advantages to being a sole proprietor possibly at the start and then migrating forward to a corporation at a later date. Other advantages, low startup and reporting cost. You can get into business for $60 by registering your business with the Ontario government, and HST registration is free, and away you go. Business cards, an office, and a telephone, and you're in business. The other part we talk about here is progressively higher income tax rates. Because you are taxed on your personal tax return as a sole proprietor, if you are one of those lucky ones that actually does quite well out of the gate and you start making considerable dollars, you're taxed at the progressive higher rates. So, for example, if you're making over $100,000, you're going to be taxed at the highest tax rate. Over $120,000 will be taxed at 46.5%. That's a large chunk out of your money. So that's where you might want to consider an alternative than being a sole proprietor, such as a corporation.
Well, can I come in for a sec?
Sure.
And ask a question? When it comes to the changing from a sole proprietorship to actually licensing your business, then at that point, is it better to do it at, say, the start of your fiscal year, or does it just make things just a touch more complicated than normal when you're doing your end-of-year tax returns?
That's a good question, but actually the timing doesn't really matter. I wouldn't wait for the end of the fiscal year, because sometimes it's better. For example, now it's October 1st. If you have had a good year as a sole proprietor, for example, I have a client right now that we did exactly that for. They were operating as a sole proprietor. They were starting to make some pretty decent profits, so we became a corporation as of October 1st. Their income will stay inside the corporation now, and they won't have any more personal income, so their personal tax return will be a little bit less than had they than if they would have stayed that way. So good question. So it's always best to take advantage of things immediately if you can defer taxes out. Any other questions from all you hundreds of people out there today? Okay. We'll go to the next slide then. So the next issue is, what if I have a partner? Could be one partner, two partners, multiple partners. The thing is, a partnership still operates on the same premise as a sole proprietorship, which means that you still have to claim the income on your personal tax return. You still don't have limited liability. The issue with partners is that you now have other people who want a decision in the business. And that might be a simple thing if you're all on the same page, if you're all thinking the same direction in the business. But you do need to be aware that a partnership is to be taken just as seriously as a marriage. You don't want to get into a partnership with somebody you don't know or you don't understand or you don't see eye to eye with. That could be a recipe for disaster. The other thing you might want to make sure is that the partners have the same work ethic. I've seen it so many times where partners get into a business together and the one person works 70% of the time, the other person works 30% of the time. When it comes time to splitting profits, they want to split it 50-50. Those are issues you have to discuss right up front, get a partnership agreement going, and take it from there. Net profit equals personal income based on partnership percentage. Again, that's where you have to have an open relationship with your partner and say, okay, Dave, we worked well together, except I worked harder than you did, so I'm taking 60%, you're taking 40%. He says, other way around. But again, whatever the split is, that's what we have to claim on our personal tax return. So that also gets into the limited advantages of profit. If we're making very good money, again, we're claiming all this income on our personal tax return where it's a graduated tax, which means we're going to pay a higher and higher tax rate the more successful we are. And we all know Mr. Harris just will spend that unwisely, so why would we do that? Medium startup costs and reporting. Again, all you have to do is register your company with Ontario government. So your business is started. You don't have to file anything other than your personal tax return. So it's just a matter of having good bookkeeping, QuickBooks, Simply Accounting, and carry on from there. So,
is there a particular software that you would suggest out of any of the major ones? That would be FreshBooks.
Yeah, my firm actually really prefers QuickBooks. We find it very easy for people to use. It's got all kinds of wonderful reconciliation processes. You can use it for payroll. They now have a QuickBooks they can use in the cloud. So you can be at your cottage, you could be at your office, you could be down south, and all you do is sign on to the cloud, and there's your books and records right there. It's great for people who are traveling a lot for their business. They can still maintain their books and records anywhere they go or see the activity as well as that too. So partnerships are not as common as you might think. It usually goes from sole proprietor right through a corporation. The one caveat that you have to be concerned about here, a lot of spouses will register, like say, I'll just choose a man, becomes a painter. Okay, so he's a painter, he registers himself as a sole proprietor, but then down the road he starts deciding to split his income with his partner, his spouse. So he'll take 80%, put 20% under her tax return, but he forgot to re-register his business as a partnership. That's where the problems come into play, and I've seen that happen a few times too many, where Revenue Canada audits you and says, wait a minute, you've been splitting your income with your wife for the last 5 years, but you're registered as a sole proprietor, not as a partnership. Disallowed. So if you are finding that you're in that situation where you're starting to split with your partner, re-register your business as a partnership. That way, Revenue Canada cannot disallow that. Any other questions on that? Okay, we'll go forward to the next slide. This one? Yep. The most common type of entity is the corporation. Okay, the corporation provides you with a lot of advantages, but it also provides you with some additional headaches you have to be concerned about. The corporation is one or many shareholders, owners. You can be a single owner of the business and be the sole shareholder, or you can be one of many people that you decide to make in as partners as shareholders. The nice thing of the corporation, it's a separate entity altogether from you. It's taxed at a preferential rate if you're a Canadian-controlled private corporation, which most of us are in this area. The tax rate is only 15.5% for the first $500,000 of profit. That is a substantial savings, but the key here is the money has to stay inside the corporation. If you take the money outside the corporation, it's either taxed in your hands as a wage or a dividend. Where a corporation comes into play is tax advantages, if you can leave money in the business, or insurance purposes. If you're in a business that you're concerned about lawsuits, litigation, you really want to have this shell to operate under because it gives you limited liability. And what that means is that if there's any issues whatsoever, they can only go after what assets the corporation owns. They can't go after your personal assets. So your house is not at risk, your cottage is not at risk, your favorite dog is not at risk. You're fine. Now, saying that, there are some liabilities that can proceed to you personally, and that's, of course, our government, because they can write the rules. So if you're offside for HST or wages, they can go after you for your personal assets. So like we advise most of our clients, make sure they get paid first, just to take advantage of the government so they don't bother you. Okay? Other things, the income splitting here is advantageous as well, because here it becomes so easy to put partners, spouses, children that actually work in the business on the payroll. So income splitting here is a lot more advantageous in a corporation because especially nowadays with the advent of internet and online marketing and so many things that the youth are keen on, it's easy for your son or your daughter to get involved in your business and help you with your marketing or help you with your organizing your workbooks or QuickBooks or whatever you decide to do, and you can put on a payroll. A great splitting because the first $11,500 that you make in income personally is tax-free. So if you have a son or a daughter who works for the corporation and makes $10,000 for the year, they won't be taxed on that. Whereas if you took another $10,000 out and you're already making a decent income, you're going to be taxed at a progressively higher rate. So it does give you a lot of opportunities that way. Disadvantages, high startup costs. You have to incorporate, and that costs you anywhere from $1,000 to $2,000 for legal fees. Reporting requirements, you are expected to have a QuickBooks, a Simply Accounting, fresh books. You must have proper accounting records because if you're audited and your corporation, CRA expects you to be operating in a prudent fashion where you know what you're doing and reporting everything properly. So stringent record keeping is a must. If you can't do it yourself, hire somebody to do it. If you're paying anywhere from $25 to $60 an hour for bookkeeping, that's cheap because you can use that time to go and get more business for yourself and increase your own business. There's a thing called lifetime capital gain exemption available, and a lot of people don't know what that is, but that is the sweetest thing that is available to us as business owners. You start your business, you work it very hard, you ramp it up, you build something that is now of value. You've got, fast forward 15 years, 20 years, you've now got a company that's doing $1 million worth of business. Somebody's going to come there and offer you, $500,000 to buy your business from you. Okay? That $500,000, if you sell the shares of your business, is a capital gain to you. But the government has this new program, which has actually been around for quite a while, they just keep raising the rates, that the first $800,000 of capital gain on the sale of your business is tax-free. So imagine this situation, you and your partner, your wife, your husband, both own the business equally. Okay, so I have David and Dana here in the office. Assume that they both own this corporation equally. They sell the business, and they sell the business for $1.5 million. Because they both own it equally, they both can share the capital gain exemption of $800,000 each. So that $1.5 million sale, they would each get $750,000. The entire amount they receive is tax-free. You can't go wrong with that. If you're a sole proprietor or a partnership, that $1.5 million will be taxed at the highest tax rate, 46.5%. So here's another strategy. If you are sole proprietor, if you're a partnership, if you think you're going to sell your business in the next couple of years, you want to incorporate it because you have a 2-year window before you can actually qualify for that capital gains exemption. So again, it pays to talk to a tax professional, like myself, plug, to see what you can come up with to help you out that way. Any questions so far? Nope. Easy audience. Debt and equity financing available. What I mean by that is that banks and other institutions, of course, will lend you money, loans, whatever. Equity financing is other people who might want to buy into your business. And what I mean by that is that they might like your business so much that they're willing to ride on to your coattails and say, I want a piece of the action. You can actually sell them special class shares, preferred shares. It doesn't give them any voting rights. They don't have any ownership over the business, but it does give them a chance to share in the profits and the growth of the business. So what they do is they give you money and they buy these shares from you, so equity financing, and that allows them to collect dividends as the company grows. That is not available in any other entity at all, so a corporation is definitely the way to go for this. I would say the majority of our client base is operating as a corporation, and even if you're a single person out there and you're concerned about liability, you're concerned about your house being put on the line, I would strongly recommend a corporation is the way to go for most of you. Okay, we'll flip to the next page. What I want to cover here is management issues. Because I see it so many times, people have a good idea, they want to start their own business, they're very good at what they do, so all of a sudden they put this shingle out in front or this business card. They're now, an auto mechanic with their own business, they're now a carpenter with their own business, they're now a chiropractor with their own business. Whatever profession you're in, management issues rise up in every organization. And the things you have to be aware about: increased financing is required. As soon as you start your own business, your paycheck as an employee stops. You hopefully have income put aside so that you can still afford to pay your mortgage and eat. You need financing to grow if you need to buy capital assets, equipment for your business. Okay. Maximize capabilities of existing human resources. What I mean by that is that at the start, if you're by yourself, that's you. Existing human resources is you. So now you have to look at yourself and say, how am I working? Am I working the most efficiently? Am I letting too many people take advantage of my time and I'm not being productive here? So you have to really get into time management for yourself. And it sounds cruel, but you have to identify who is wasting your time and who's not. If you meet with a prospective client or customer and they're rambling on and on and on for about an hour about their cottage and their kids and everything else, that's not all that productive time for you. You need to try and get that down into, more manageable slot. I'm not saying not talking about that, but you have to understand that you have to do the work as well as the marketing, as well as the, all the production, everything else involved. So you have to be aware of human resources. You might have to start eliciting help from your spouse, your kids, friends, family, or hire a person. And when you hire a person, you have employees, and that becomes a whole new issue as well. As your business grows, policies and procedures of business operations, you hire your first employee. Well, they need to know, how does your business operate? What are the policies? What's my hours of work? What's my vacation time? When can I actually, leave and come? What do I have to do here? So you actually have to take time to have all that written out in order for them to understand and work efficiently. That takes time. That takes time away from you and your selling and your artistic abilities to grow your business. Internal control issues. The buck stops here. That's a famous line. The buck stops here if you actually have enough controls to make sure the buck flows through to you properly and doesn't get diverted along the way. Because the more employees you get and the more busier you get, the more you tend to take your eye off the ball just to try and get the work done. But you have to have enough internal controls to make sure that your cash is being protected, your clients are being protected, and almost more importantly, the privacy of your customers and your staff is being protected. So again, it's those administrative issues that have to be taken care of that if you don't have the time for, prudent management says, hire somebody. If you don't have the time to write policies and procedures, hire an HR professional. If you don't have the time to do the bookkeeping and accounting, hire an accounting firm or a bookkeeper to help you out do it. If you don't have time to do the sales and marketing, hire a person to do it. So these are all issues you have to look at when you're establishing and growing your business. And the growth cycle is the most crucial part of a company, and that will occur in your first 1 to 3 years. That's where you're stretched the most. You're stretched with resources, you're stretched with finances, you're stretched with trying to grow the business and still maintain a life. Well, for somebody who started the practice from scratch, let me tell you, the first 3 years, you don't have a life. Your life is your business. And if you don't devote your life to your business, chances are it won't grow. So make sure you pay attention to it. Make sure that you have all these things in place and you get help. Asset protection. I've seen this so many times. Accounts receivable especially. You are out there, you're getting business, you're growing your business, and everybody you're doing business with is on terms. They're taking their time to pay you. And you might get that 1 or 2 customers or clients who becomes a larger client or customer of yours, which means that your accounts receivable with them starts growing. If you are paying labor in order to accumulate this revenue, your labor costs are payable immediately within a week or 2, whereas they're not paying you for 30 days or 60 days or 90 days. That becomes a massive cash crunch to you. And if you're new, the bank probably will not lend you money against that. So that's where you have to be prudent enough to talk to other family members, raise some cash somewhere else, or be honest and talk to your customer and just say, you know what, I need 50% down, and I need payment within 30 days. I've seen too many companies go out of business for that one simple reason. They didn't manage their accounts receivable. It got too high. They got burned because their customer went out of business or something happened there that they couldn't get paid, and that was the death of their business. So if I can give you one thing to do, make sure that you have total control of your accounts receivable, and do not be afraid to ask your customer for payment. You've done the job, you've done it well, ask them for payment.
So, Paul, for asset protection, when you're talking to your clients and you're about ready to start a contract, is 50% a norm, or is it closer to 30, or is it industry-based?
It depends on the industry that you're in. Like some industries are, like if you're into the graphic art industry, stuff like that, it's usually a 30% down. If you're into more of a construction type, very commonly is 50% down. We have one client that's 50% down, 25% as the project is almost completed, and it doesn't leave the door unless the other 25% is paid. They don't have an account receivable, but the nice thing is they've built up their business to the point that they're in such demand that the customers are okay with that. And believe me, you can train your customers. You can train your customers to abide by whatever principles you want to operate by. If you let them have 90 days, then guess what? That's how they'll treat you. They'll pay you in 90 days. If you tell them that your terms are 15 days and you're calling on the 16th day and the 17th day and the 18th day, guess what? They'll be conditioned to pay you on that 16th day. So you have to condition your customers. Creditor proofing, liability insurance is another key one. Everybody that's operating a business better have liability insurance. And that's a simple thing from the postman walking onto your property, slipping and falling and injuring themselves, to you causing damage to your customer that causes them financial liabilities that then is going to result back to you as well. So definitely talk to your insurance carrier, your broker, and make sure you have proper coverage. It's not all that expensive for general liability insurance. Just skipping back to asset protection and accounts receivable, if you are actually doing business internationally, you can get insurance for that through a government program. So there is programs out there that allows you to get that as well. And I'll get into some cash management issues a little later on. Identify the proper organization structure. Are you structured properly? Do you have the right structure? Do you have a corporation? Okay, inside a corporation, if you started to grow it, do you have proper departments? Do you have a person in charge of your finance? Do you have a person in charge of your operations? Do you have a person in charge of your sales and marketing? Make sure you have the right organization with the right people. Market share and industry-specific requirements. This is another key one that a lot of people that are in business do not identify. They have no clue what market they want to go after and what are the industry-specific requirements of that market. Like if you're chasing textiles, well, that's a dying market. And you better understand that you're in a market that's shrinking. If you're chasing professionals, okay, depending on what the professional is, you might be able to only get one professional per city because the other professionals don't want to deal with you if you deal with their neighbor. Understand your market and who you're going after. Okay. Customer service for new and existing. Customer service is the key, especially when you're starting your business and it's growing. You really should try and get back to any phone calls or any email inquiries within one business day, within hours if you can, because a lot of new clients nowadays are calling you, they're waiting for maybe a half an hour, then they're calling somebody else. If they're already an existing customer, they'll give you that latitude, but if you don't call them back within a day, they will usually be upset, and now you're playing damage control, and why do you want to do that? I think some of the, if I can speak for my own, when I started my practice, I called at nighttime. I called whenever I could to make sure that they knew I was working on their stuff and got back to them right away. Is it a pain? Absolutely, it's a pain, but it's necessary in order to make sure that they are on your side and you're working on their best interest. Government reporting and payment, key, crucial issues. Government reporting, if you're not on time, the penalties become substantial. And even if you can't pay it because you don't get the money, still report it on time. The reporting on time will alleviate you from the penalties. The payment being late will just incur interest. But the payments become progressively, the penalties become progressively worse the more you've missed, to the point that they could actually, stop you from doing business. And that is where they can actually go after you personally if you haven't paid everything on time. So I can't stress enough, government reporting and payment is crucial to your business and to make sure that you stay on side. If you don't have any other questions, I have a whole bunch of issues on cash management that we can go to, and I'll be on the next slide as well. Cash management, there's a whole bunch of different areas you can look at cash management. And I know a bunch of you are looking at it saying, I just want to build this widget. I just want to service this person. I don't want to get into all this other stuff you're drowning on about right now, Paul. But you know what? You're a business owner now. And a business owner means you're more than just a carpenter. You're more than just a web designer. You're more than just a graphic artist. You are a business owner. You have to be concerned with all these aspects of running a business. Cash in the bank. Cash is crucial. A company will fail because of cash management more than it will fail because of any other reason in a startup phase. As you grow, we've already identified the need for cash. If you're in a declining market, then cash becomes even more crucial because of the need to resurrect it. So cash in the bank, if you have interest income coming in from any deposits or savings accounts. Service charge cost. It blows my mind how many people don't look at how much the banks are charging for service charges. Deposits cost you, withdrawals cost you, your monthly activities cost you. That is actually a negotiable amount. You can talk to your bank and get that negotiated. So take a look at your service charges and talk to your banker and get a better deal. Number of accounts. I've got one client that's got an account per project. They have like 15 accounts that's each incurring service charges. Ask yourself the question, do I need more than just one checking account? And only you can answer that if that makes sense or not. Overdraft and fees. Okay, overdraft and fees is an interest charge on your borrowing. And chances are, like all of us in the first few years, you will operate on an overdraft. That's going to be a cost to you. That's a negotiable cost to you. You can talk to the bank and you can get that reduced. If that bank won't do it, there's other banks and institutions out there. Electronic or manual. I don't know about you, but I've been using electronic more and more lately. I think every bill that we have really gets paid electronically. It is a great way to do things. You have an instant record that has been paid. You have a receipt right there in your desk. The money's taken out of your account right away. There's no concern about it being lost in the mail. You're getting cut off for that reason or whatever. And it's a less expensive way to go because the banks don't want to process checks anymore. So these things you have to be aware of. Okay. Accounts receivable. We've kind of talked about it a bit already, but number of days outstanding, what that means is that how many days on average is it taking for your customers to pay you? And if you contact me, I can give you the formula to figure this out. But if your terms of sale are 15 days and you calculate your receivables to be 25 days, it's telling you that it's taking you 10 extra days to collect your money than you actually want it. Chances are your terms of sale are probably 30 days, you're getting paid in 45 days. You're probably paying your bills in 30 days or less. So guess what? You've just created a cash flow problem to yourself because you're paying your bills faster and you're collecting your money. You want to try and time your payments to when you're receiving your money. Bad debts, to a large extent, are within your control. Bad debts occur a lot of times because you've taken your eye off the ball and you haven't asked your customer for payment. And they've gone on and on and on. And unfortunately, they've become disenchanted with you, that they don't want to pay you anymore, or they've gotten into financial difficulty, or they've become bankrupt. But had you been proactive and worked with them at the start, you might not have gotten burned for as much or any at all. So bad debts are relatively within your control. Don't be afraid to ask. You've done the service. Don't be afraid to ask for payment. Service technician follow-up calls. Again, this is a staffing issue. If you're in a business where you have service techs going out there and doing work, and the work has not been done properly the first time, they have to go back out there again to do some more work. That's cost to you. That's usually not a chargeable service. So you have to monitor this to make sure that the work's been done properly. Same with CSR, customer service relation follow-up calls. You want to really make sure that you stay in touch with your client, make sure that the service that you perform for them, they're satisfied with, they're happy with. One of the first things I do when I have a client that hasn't paid me in the past due, I'll call them and say, were you satisfied with the business? Was there any problem with the business? No? You were happy with it? Well, then pay me. And that's when we get into the nitty-gritty of why they can't pay you. They want to, they might not be able to. And a lot of people think they have to pay you 100% of the money or they don't pay you at all. Well, that's wrong because that's where you'll burn for the money. Start getting payments. Start getting 10% a week and getting money out that way so that you start making something.
So would you suggest even when you have a set of clients who are routinely late, then to try and schedule or at least let them know that you can do quarterly payments or exactly work that into your actual AR format?
Yeah, that's a very good question. If you have clients, and some are habitually late all the time, that's how they operate. As Dave said, you follow up with them, you get them on a payment plan, you might get them to actually start paying you so much money per month. And we actually have a few clients that work that way. They pay us a set amount every month, all the time, because it's easier for their cash flow, and we just constantly reconcile with them all year long, and it's a great way to go. Some actually give us their credit card, so it's just automatically, as you cut the invoice, you put it through on their credit card. That's the beautiful thing if you can ever do that. Take a look at your terms of sale and take a look at what it says on your invoice, because your terms of sale have to be on your invoice. They have to know when is it due. You should also stipulate on your invoice what happens if they don't pay it. Then interest is going to accrue at 1% a month, 2% a month, whatever. Also put on there that if you have to take them to small claims court, they will also have to pay that. And if you ever need good wording, just contact me offline. I can give you the exact wording because been there, done that. Once you learn, you'll find out really fast how to make it work properly. Insuring or factoring. Factoring means that you actually sell your accounts receivable to somebody else. And there's companies out there that will buy your accounts receivable and pay the money up front. So if you have a business where you're dealing with larger players and they habitually don't pay you for 120 days, you can't afford to wait 120 days. So there's factoring companies that will give you a percentage. Let's just call it 95% up front right today, and they earn the 5% fee by waiting 120 days to get the money from your customer. So it's a financing alternative. Now, it's not cheap, but it also allows you to get over a hurdle if you're into a large growth phase. So something to think about there. Inventory. If you are a business that you have to carry inventory, if you're into sell up goods as opposed to services, you have to look at what am I carrying. I met with a client this morning who's in the fashion business, and believe me, you want to be very cognizant of what inventory you have when you're in the fashion business because it goes out of date and style very quickly. So you want to look at the turnover of the product. How fast is that turning over? Because if it's not moving out on a quick enough basis, it's getting stale. If it's a fashion product, it's getting out of date. If it's a ingestible, then it could be getting past its due date. So you want to look at each individual product. How fast is it actually coming in and leaving? And if it's not moving on a quick enough basis, and only you can determine that for your industry, and we can help you with that by industry, but you have to figure that out. Saleability at full price. How much of your inventory can you actually sell at full price versus having to discount it, to get it up the door? So you need to understand the market share. You need to understand who my competition is and what can I sell this product or this service for. Obsolescence or discount. Again, you have to look at the product you have. And if you see that you have products getting a little older, now's the time to discount it and get it out the door before it becomes totally obsolete and can't be sold at all. Products like that, you can sometimes say, okay, buy 2 of these good products and you get 1 of these ones for free, just to get things moving, just to clear out your warehouse. Lead time for purchase and sale. So many people have been caught short. You get a product that's really doing well, it's selling like hotcakes, but you forgot that the lead time is 10 weeks to replenish your order. Now you're out of stock. Now you've got missed opportunity. So you have to also be aware of these things too, and just say, okay, I need to constantly be aware of the activity on the sales end so I can buy it on time to have more product to sell. And then finally, minimum maximum order quantity. How much do I buy? Again, that's a call that you have to make because you might want to buy larger volumes in order to offset your freight costs. If it's a product that has a shelf life, you might want to buy smaller lots and pay a little higher freight cost just to avoid being obsolete inventory on your side there. So inventory management is a very specialized area and not to be taken lightly if you're in that business. Capital assets. Capital assets are equipment that you use to run your business with. Vehicles, machinery, computers, all that is capital assets. And there's many different ways and forms that you can look at a capital asset. And you have to look at, is it required or do I just want it? Do I need that super deluxe fancy photocopier, or can I just go buy a small little thing that does the job for me? You have to kind of look at wants versus needs. Purchase versus lease, okay? Everybody needs a vehicle to get around nowadays, and that's probably the most common question asked me. Do I buy a vehicle? Do I lease a vehicle? And there's no easy answer because it's a per situation answer. You have to ask yourself a question. Do I get bored of my vehicles fast? Well, then I don't want to buy it because I'll be here forever. Do I put a lot of kilometers on my car? Well, if I do, well, I'm going to pay a substantial penalty on the lease end of things. Can I get bank financing to purchase? Possibly not, because I'm a startup business, then I'm forced to lease. So there's a whole bunch of different issues you have to look at that way. Depreciable versus appreciable. And here's where, not just in business, but in personal life, I see a lot of people wasting their money. They buy items that depreciate. They become worthless versus things that appreciate. For example, you decide to rent a facility and buy yourself a Lexus car to drive around, as opposed to buying the land and building and driving a little Honda Focus or something like that, or Ford Focus. Buy the things that appreciate. Rent the things that depreciate if you can, if the money is tight that way. So you have to kind of look at the strategy of what's going to make you money long term, because you're in business for long term. You're in business to accumulate wealth, not to just have flashy vehicles and flashy things in your life now that 10 years from now aren't worth a penny. Final thing is ownership and creditor proofing. Okay, so how we structure things with a lot of our clients is, if you're at that stage now where you're going to buy your own building and you're going to have your own facility for your business, here's where you might get into the multi-corporation structure. We might actually have you buy that land and building inside a separate company that can then be rented to your existing operating company or to others. And the reason being is that if you're building your business up to the point that it's done extremely well and you can sell your business, wouldn't it be great to sell your business but still have the land and building in a separate company that you own, so the new buyer now pays you rent and you have that continuous income happening? So these are the things that you want to give some thought to ahead of time before you do these acquisitions. So again, another reason to talk to your tax professional or your accountant as well.
So Paul, are there any, when it comes to capital assets, are there any tax implications or benefits that your average business would be privy to?
Yeah, there are some tax differentials. Again, on a purchase for a lease. Okay, if you purchase a vehicle, you can have a 30% depreciation, versus if you have a lease, you can write off the lease value. Most of the time, the purchase will give you a higher depreciation cost in the first few years than the actual lease cost. So you will then reduce your income. So you'll reduce your taxes payable because of that. So again, these are things you have to be concerned about. If you are in a break-even or loss situation, that doesn't matter. And usually cash management at the first stage of your life, the first 1 to 3, 1 to 5 years, is almost more important than tax management. And Jason, our tax partner, I'm sorry I said that, but cash management is more important than tax management at the start. We can go to the next slide, I guess. Again, trade payable, that's don't want to touch on this too much, but you have to pay bills. Whatever you do, you're going to incur some bills to pay, so you have to look at those in terms of sale. And again, you can negotiate with whoever you buy product or services from, is that if you need to get professional services from a lawyer or an engineering firm or whatever, talk to them about their terms of sale. And if they need it in 15 days, but you know you can't pay them for 30, ask them for 30 days. You never know. You might get it. Some companies give you discounts, 2%, 10 if you pay it right away. That can add up and be quite a savings. So you might want to take a look at that. And if you have the ability, take advantage of the discounts. Vendor relations and supply. That's very crucial, because the better you get to know the people you do business with, customers as well as vendors, the smoother your operations become. And if you have good relations with your vendors and you need that product quick because you sold out, you need more product fast, guess what? It's going to be there on your doorstep a lot quicker than if you have a caustic relationship with your vendor. So being nice works on both ends of the spectrum here. Duplicate payments, proper accounting, and I've seen it so many times. People will pay from a packing slip, then they'll get the invoice and they'll pay from the invoice. Have proper accounting systems and have proper internal control set up so don't pay things twice, because not every vendor is going to tell you paid that bill twice. Some will. Legitimate supplier payments. Be aware, there's a lot of scammers out there, and you will get invoices from different advertising mediums, different things saying that you owe us money for this service we provided for you. Well, if you're really extremely busy and you're just flying, you might pay that without even giving a thought to the fact that, you know what, I didn't even order that. I don't even have that. So be aware. Don't sign a check unless you absolutely know what it's for and that's legitimate.
So you would suggest in those types of situations, actually, when you're writing a check out, to have the invoice that you're ready to fill out right next to you?
Absolutely, yeah. Have all the documentation to support it right there to make sure. And if you're not even sure at that point in time, call and inquire and ask for a copy or something else to legitimize it. Service charge costs, number of accounts, overdraft, electronic manual. Again, the same idea here as with receivables, just on the opposite end. Okay, am I incurring service charges for being late? Do I have a different number of accounts with different suppliers that provide me the same thing? Well, maybe you can shortlist it down to 2 suppliers instead of 10 and get better terms of sale because of that. And again, electronic or manual. If you pay them electronically, chances are they'll prefer that a long ways as well. So different things to think about. So finally, I just want to touch on tax and investment planning, because I know we're starting to run a little short here. Income and profit splitting. You want to look at how are we going to do that from best in your hands point of view. How much income do I need to live? The best thing with the corporation is that, let's say Utopian that's made $100,000 profit, but your life is so modest, you don't need that. You only need $50,000 to live. Leave the other $50,000 in the corporation, pay the corporate tax, leave it there, and invest it inside the corporation. Types of income earned. We need to sit down and say, do you want dividends? Do you want wages? Do we need to borrow funds? Do we need to invest in real estate? We have to look at that and say, okay, what is the best strategy for you along those lines? Potential sale or transfer value of the business. This is an exercise in itself. This is a couple of webinars in succession planning, estate planning, like how do I sell my business? How do I pass from one generation to the next? There's all kinds of discussion of that. Again, these are just tidbits for you to see if there's a flavor of what you need to discuss. CPP, EI contributions or not. Of course, Canada Pension is contributed if you have a wage, but if you take a dividend, then there is no Canada Pension. You have to decide if Canada Pension is important to you once you retire, and if it is, well then dividends might not be the way to go for you. RSPs, registered pension plans, RCAs, IPPs, there's all kinds of tax deferral methods out there for registered pension plans, and again, they don't fit for everybody, but they are available, things to talk about. Interest deductible issues. You can deduct interest charges on legitimate investments, but there are instances when you cannot deduct interest. And again, this is a different seminar altogether, but just things to be aware of. The whole thing is the government looks at your business and says, is there a reasonable expectation of profit? Are you in business to eventually make a profit? And if you are, then we're going to allow all these business expenses and all these different maneuverings that we're doing. If you're doing it just to scam and shelter from paying taxes, chances are a lot of these things will be undone. This is where you need the services of a professional accountant or tax lawyer to help you out. Which leads us to the final slide, and that is business support. When you're starting off your business, or if you're already into your business, you should make sure you have the best of these available to you. Get the best accountant, and I know of one if you need one. Get a really good lawyer, financial advisor, insurance agent, banker. If you need temporary staff, get to know a really good personnel agency that's out there that understands your business and understands your needs and is willing to work with you. Professional trade association. If you work with unionized workers a lot, get to understand the unions and the professional trades that are out there. And believe it or not, competitors. Competitors can be a huge support to you, because there's a lot of business out there to be had and a lot of business to be shared. And what I found when I was actually in the corporate world before I started my practice is that some of my competitors became customers, friends, and still are competitors. We shared strengths, and we worked on helping out each other at times. So don't be afraid to go and introduce yourself to your competitor. You might find out that they're weak in an area you're strong, and they're strong in an area you're weak, and your competitor, who knows, one day might become your partner.
Some of the best partnerships I've ever seen in the chamber come out of two competitors just teaming up on a project.
It just makes sense. And how many people won't talk to each other because of that? So that's it. I hope you've all gotten something from this webinar. It's the first one I've done, and I kind of feel great doing this. So thank you very much.
Thanks.